closing in on $40 a barrel this week. Global supply excesses top the list of concerns as inventories climb. The question today is, will it fall below $40 and how low can it go? Michael Lowen, commodity strategist at TD Securities. Good to have you, Michael.
Thanks for having me.
Now, my only question is, how low can it go?
Well, if you remember, last time I was here in February earlier this year, we were calling for mid-30s, so $34 to $35 per barrel. I think there's a distinct possibility that we could get there.
Because it has been quite low. Now, you've brought me a couple charts to kind of flesh out this topic that we're looking at today. The first one is the weekly U.S. crude oil imports from Canada. What does this show?
Basically, what this is showing is a rebound in Canadian imports into the U.S. The reason for the dip there that we have circled is there were forest fires in the Western Canadian Sedimentary Basin, or in Alberta, that took supply offline for a number of weeks, almost a month and a half. Those volumes are starting to return, and they are dipping into the U.S. Midwest, which are increasing supply, or basically they're weighing on storage there, which impacts WTI.
Okay, so that's, it's good for us, maybe not so good for the price?
Exactly. Well, the interesting thing is we get a boost for volumes, but those additional volumes are going to weigh on price, and therefore you're getting paid less per barrel.
Okay. And your second chart is crude oil demand from U.S. refineries. Now, you said this was interesting.
Well, this is what's happening right now and what is going to happen in the near term. So last week, Whiting Refinery, which is north of Cushing, went offline. It was quite a large one. I believe it's the 6th largest refinery in the U.S. and certainly the largest in the Midwest U.S. What makes this very important is not only that its size, but its location in proximity to Cushing. Being north of Cushing, this refinery actually processes a lot of Canadian crude oil. With nowhere to go and volumes increasing, or imports from Canada increasing, those volumes are going into storage, which is inevitably weighing on Cushing stockpiles, which is the delivery point for WTI contracts. Okay. Going forward, it looks like it's going to get a little bit worse. Many refineries go offline kind of late September, early October. This is a typical seasonal thing, and when that happens, we'll see a lot of demand fall off for crude oil, and so we should see storage start to take up quite steadily at that point.
But it doesn't stay there forever, obviously.
No, we should have refinery demand kind of return late Q4, and by that point, we'll be in a little bit of a different scenario in the U.S.
So what do you see longer term?
Well, it's exactly then. We kind of see an inflection point in crude oil demand as well as supply in Q4. While demand is falling off, we have our seasonal refinery outages. We also have been noticing that supply in the U.S. is starting to plateau and starting to fall. This has been expected we've had 4 months of declining investment in the industry, and as this continues with rig counts and investment in general in the industry, supply should start to taper off, and before you know it, we'll have quite a significant less amount of production coming in the U.S.
And then that should affect the price in a positive way?
Exactly. We should see the U.S. starting to tighten up. And not to mention, you have to also think about the rest of the world. So when I mean rest of the world is non-OPEC, about 60% of the world's oil production is non-OPEC. We focus on the U.S. because data from the U.S. is usually the most timely. Okay. We also look at it as basically a bellwether for what is happening in sectors or regions outside of the U.S. So what's happening in the U.S. right now is likely also happening in Canada, in Brazil, and many other producing regions.
All right, so mid-30s. And then hopefully back up to some sort of normal. What would you say is normal?
Well, new normal is wait and see. It's kind of a new thought right now, with the average break-even cost for crude oil production coming down due to a number of factors, being technology as well as the actual unit labor costs. Break-evens are lower, therefore your marginal cost of production or where you think prices should rebound to will obviously be a little bit lower as well. We think that $60 to $65 is not unreasonable for 2016, especially when you have production really starting to fall off in 2016 due to lack of investment and demand holding in there, hopefully with China coming back by that point.
All right. And with, as you said, technology changing the oil industry in such a huge way and costs coming down, do you ever see it going back to $100?
I think it's too early to say for that for sure. The reason why we are where we are now is because we've had a persistently long period of time where we've had oversupply to the tune of 1 to 2 million barrels per day. So from Q3 last year to about now, we have been producing to that tune 1.5 million barrels more than what the world needs. We've built up a lot of inventory. We have to get through that inventory overhang before we can actually start reaping the benefits of a tight oil market. The reason why we were at $100 or $100+ previously is because of a decade and a half of very tight crude oil markets.
Well, you know what they say, the cure for a low oil price is a low oil price. So we definitely have that. Thank you very much, Michael.
Thank you for having me.
I've been joined by Michael Lowen, commodity strategist, TD Securities. I'm Marianne Deveni. Thanks for watching.